The classified balance sheet refers to a balance sheet where the information is broken down into several categories. We're going to talk about the different type of assets with a classified balance sheet: current assets, long-term investments, property, plant, and equipment assets, as well as intangible assets. We'll talk about the different type of liabilities, current liabilities and long-term liabilities. And we'll also focus on the equity section of the balance sheet. We'll look at owner's equity as well as stockholders' equity and discuss those components. Here we have a sample of a classified balance sheet. This is showing the asset section of the classified balance sheet, listing all of our current assets, long-term investments, property, plant, and equipment assets, as well as intangible assets. Notice that for each of these categories, they're going to have a subtotal for the current assets, for the long-term investments, what we call PP&E, property, plant, and equipment assets, as well as the intangible asset. Each category has its own subtotal to get the total assets on the classified balance sheet. And we're going to go through these different categories in a few minutes. For the liability section, we have what's called current liabilities as well as long-term liabilities. And once again, each of these categories have their own subtotal. Add those together to get your total liabilities. For the stockholders' equity section, we have what's known as common stock and retained earning to get your total stockholders' equity. And as always, the balance sheet must do what? It must balance your assets, which total $61,400, must also equal your liabilities and your stockholders' equity. Let's take a deeper look into these different classifications shown on the classified balance sheet, beginning with our current asset. The question is, what does it mean to be a current asset? This is an asset account that we expect to convert into cash or use up within 1 year or within one operating cycle, whichever is longer. When you think about an operating cycle, what is that? It is the average length of time it takes to purchase inventory, sell the actual inventory on account, meaning that they haven't paid us yet, and then collect cash from those customers. So the average time it takes to acquire an inventory item, to sell the item. Recall that most business transactions, or what we call on-account transactions, credit transaction, meaning that the person that's making the purchase does not pay cash up front for those items. So if the operating cycle is, say, 18 months, then to be a current asset is an asset account that we expect to convert into cash or use up within 18 months. If the operating cycle is less than 1 year, then we're going to use the longer of these two, which in this case would be the 1 year time period. So samples of current assets are cash and cash equivalents, short-term investments. These are items in the form of cash or can be converted into cash. Account receivable and inventories. Account receivable shows money owed to the actual business, which at some point will be converted to cash. Inventories are items that we plan to sell, and once we sell those items, they'll become account receivable and then later on cash. Prepaid expenses are those items that we expect to use up, whether we're talking about prepaid insurance, prepaid rent, supplies, or examples of different types of prepaid expenses. So notice the order. They're listed what we call an order of liquidity. Liquidity focuses on how easy can I convert these items into cash. Next categories are our long-term investments. When you think about long-term investment, if we acquire the stocks and bonds of other companies and our intent is to hold them for a time period longer than 1 year or longer than our operating cycle, those are known as long-term investment. Or if I acquire assets such as land or building that I do not plan to use, these items are being held for resale. They're also referred to as being a long-term investment. So we may purchase land at a price because we feel like it's a good price, and because of development in that area, we know that the land value will go up pretty soon. So we're just going to hold that land, and our intent is to sell it at a later date. Or if a customer owes us money and we give them a time frame longer than 1 year to pay, that's known as a long-term receivable. So on our balance sheet, we're going to list all of our long-term investments in this section of the balance sheet. PP&E stands for what we call tangible assets, operational assets, assets being used by the company to earn revenue for the business organization. It could be equipment, machinery, automobile, buildings. These are assets that are going to be used to help us earn revenue. Now, these assets go through a process known as depreciation. What's depreciation? It is a system or a process of taking the cost of those long-term assets and expensing the cost over the asset's useful life. So a quick example, if I purchase equipment for $30,000 and the equipment has what we call a 5-year useful life, then the cost of that equipment becomes an expense over the next 5 years through a process known as depreciation. So we have a contra asset account known as accumulated depreciation. This account keeps track of how much the assets cost have we depreciated so far. So with our equipment example, if the equipment costs $30,000 and it has a 5-year useful life, we're going to expend $6,000 per year for the next 5 years. So at the end of, say, 2 years, the amount that we have accumulated depreciation would total $12,000, $6,000 each year for the first 2 years. So on the balance sheet, we're going to list all of our PP&E assets at their original cost, but we're then going to show how much of that cost has been expensed so far, depreciated, which is shown in the accumulated depreciation account. And this net amount here is known as the current book value of our property, plant, and equipment assets. Next, intangible assets. When you think about intangible assets, these assets do not have per se a physical presence. However, they are assets because if you own these assets, you are entitled to certain rights and privileges as being the owners of these intangible assets. So I'll talk about a few of these items such as trademarks, brands, or either trade names. So let's say if you wanted to produce a product, you wanted to make some type of a tennis shoe. You cannot use the Nike name nor the Nike symbol because those items belong to the Nike company. Understand that people will pay more for a pair of tennis shoes just because it has the Nike name on it and the Nike symbol. So think about the items you have purchased from a clothing standpoint. There are certain items that you have paid a premium price for just because of the name of those items. So on the classified balance sheet, we list all of our intangible assets in their own section of the balance sheet. Let's move on down to the liability section, and the first group referred to as being current liabilities. So current liabilities are those liabilities that will become due within 1 year or within our operating cycle, whichever is longer. Example would be items such as accounts payable, salaries payable, interest payable, etc. So think about your current liabilities. These are obligations that must be repaid within 1 year of our balance sheet date or within our operating cycle, whichever is longer. So I'm going backwards, but here's an example of the current liability section of the balance sheet. Notice it's showing all of our notes payable, accounts payable, but we're going to get a total for all of our current liabilities. For your long-term liabilities, these are obligations expected to be paid a time period after 1 year. So these debts will not become due within 1 year. They're going to become due after 1 year. So with your long-term liabilities, whether you have things such as your mortgages, long-term debt, again, these obligations will become due in a time period longer than 1 year from your balance sheet date. Our last category is our stockholders' equity section of the balance sheet. So with stockholders' equity from a corporation standpoint, you're going to have the section known as common stock and retained earnings. If you have a proprietorship, it's known as owner's equity instead of stockholders' equity. And for proprietorship, you're going to have what's called a capital account shown for the owner of that business. When you have a partnership, which is also called owner's equity, you will also have a capital account, but you're going to have a capital account shown for each partner of that partnership. So this section here is going to vary depending upon the business structure. Is it a proprietorship? Is it a partnership or a corporation? And that would indicate the account titles used for the equity section of the balance sheet. So when you put everything all together, here we have all of our assets, the different categories, the total for each of those categories to get total assets. And we look at all of our liabilities, current, long-term, total liability, the equity section, this is the corporation. And the balance sheet must always be in balance. Your assets must equal your liabilities plus your stockholders' equity.